Hey everyone, welcome to the show. Today's episode, Business Credit to Real Estate, the insider blueprint for funding properties without personal liability. Learn how savvy investors use business credit lines, EIN, and corporate structures to acquire real estate while protecting their personal finances. This one's made for aspiring and early-stage real estate investors who want to use business credit as a funding vehicle without risking personal assets or credit scores, and by the end you'll have real, practical skills you can use right away.
I'm really excited about this one. Here's what we're covering together today. Module 1, the Business Credit Foundation, building the entity that banks trust. Module 2, stacking business credit products from trade lines to six-figure limits. Module 3, deploying business credit in real estate deal structures that work. Module 4, protecting your strategy, risk management, legal structure, and long-term scaling. Grab a coffee, get comfortable, and let's dive in.
Alright, let's get into it. That brings us to Module 1. Module 1, the Business Credit Foundation, building the entity that banks trust. Set up a properly structured business entity with the right credentials to qualify for business credit products that can be deployed in real estate.
In this part of the show, we'll talk through why your business entity type changes everything, the EIN, DUNS, and business credit profile setup, seasoning your business, the timeline that unlocks credit.
Here's something most people skip right over when they start this journey. They form an LLC, get excited, and then treat the business bank account like a personal piggy bank. That one mistake can destroy everything. The entity type you choose and how you operate it is literally the foundation that everything else sits on. If the foundation cracks, your credit strategy falls apart and your personal assets are on the line. So before we talk about credit limits or real estate deals, we need to make sure your business is built the right way, the way a bank's underwriter will actually respect. Let me break that down a bit more. The legal structure of your business entity, LLC, S-Corp, or C-Corp, directly determines how lenders evaluate your creditworthiness and how much exposure your personal assets have. An LLC taxed as an S-Corp, for example, signals operational legitimacy to underwriters and opens doors to more sophisticated credit products. Single-member LLCs are fast to form, but often treated as pass-through entities with limited credit autonomy unless properly seasoned. You must register your entity in a business-friendly state, obtain a registered agent, and keep the entity completely separate from your personal finances from day one. Commingling funds is the single fastest way to pierce the corporate veil and eliminate the legal protections you worked to create.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: your entity structure is not just legal paperwork. It is the first signal lenders use to decide whether to extend you business credit. Okay, quick pop quiz for everyone listening. Which business structure is most commonly recommended for real estate investors seeking to build independent business credit while maintaining personal liability protection? Your options are sole proprietorship with a DBA, single-member LLC taxed as a disregarded entity, LLC taxed as an S-Corp with proper business banking, general partnership between two individuals. Take a second and lock in your answer.
Alright, the correct answer is LLC taxed as an S-Corp with proper business banking. An LLC taxed as an S-Corp demonstrates greater operational legitimacy to lenders, maintains liability protection, and is more likely to be treated as a separate credit entity by underwriters. Think of your EIN and DUNS number as the social security number and passport for your business. Without them, your business is financially invisible. Lenders literally cannot find you. And here's the thing. Getting these set up costs you nothing but about 30 minutes of your time. The DUNS number from Dun & Bradstreet is free, the EIN from the IRS is free, and yet most aspiring investors either skip this step entirely or do it wrong. Once these are in place and tied to a real business bank account, you've flipped the switch. Your business now exists in the commercial credit universe. Let me break that down a bit more. Once your entity is formed, your first financial move is obtaining an employer identification number from the IRS, which is free and takes minutes online. This becomes your business's social security number for credit purposes. Next, register with Dun & Bradstreet to obtain a DUNS number, which activates your business credit file with one of the major commercial credit bureaus. You should also register with Equifax Business and Experian Business separately, as each bureau builds its own independent profile for your company. Open a dedicated business checking account at a bank that reports to commercial credit bureaus such as Chase, Bank of America, or a local credit union with commercial lending relationships. Use this account exclusively for business transactions and ensure the account has been active for at least 30 to 90 days before applying for your first trade line.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: EIN plus DUNS plus dedicated business banking equals a visible, fundable business identity in the eyes of commercial lenders. Okay, quick pop quiz for everyone listening. What is the primary purpose of obtaining a DUNS number for your business? Your options are: to file business taxes with the IRS, to activate your business credit profile with Dun & Bradstreet, to open a business checking account, to register your LLC with the state. Take a second and lock in your answer.
All right, the correct answer is to activate your business credit profile with Dun & Bradstreet. A DUNS number is issued by Dun & Bradstreet and serves as the identifier that activates your commercial credit file with that bureau, making your business visible to commercial lenders. I want to be really honest with you here, because a lot of people teaching this stuff gloss over the timeline. Business credit takes time. There's no magic trick that makes a 2-month-old LLC look like a seasoned 5-year company. But here's the mindset shift: the clock starts the moment you form that entity. So every day you wait to get started is a day you're delaying your real estate goals. The good news is that while your business is seasoning, you're not just sitting around. You're building trade lines, you're learning, you're preparing your investment strategy. Use the time. Don't fight it. Let me break that down a bit more. Lenders assess business age as a proxy for stability and risk, and most meaningful business credit products require a minimum of 1 to 2 years of business history. This is called seasoning, and you cannot shortcut it, but you can use it strategically by forming your entity before you think you are ready to invest. Every month your entity exists, pays its bills on time, and maintains active banking relationships adds to your credibility profile. During the seasoning period, your focus should be on establishing vendor trade lines with net 30 suppliers such as Ullin, Quill, and Granger, who report payment history to commercial bureaus without requiring a personal credit check. By the time your business reaches the 12 to 24-month mark with 8 or more trade lines reporting on time, you will unlock access to credit cards, revolving lines, and eventually unsecured business loans.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: time in business is a credit asset. Start your entity now so the clock begins working in your favor immediately. Okay, quick pop quiz for everyone listening. What are vendor trade lines and why are they important in the early business credit building phase? Your options are: personal credit cards used for business expenses to earn rewards, credit accounts with suppliers that report payment history to commercial bureaus, helping build business credit, business bank accounts that report to credit bureaus, short-term loans from hard money lenders used to fund properties. Take a second and lock in your answer.
All right, the correct answer is credit accounts with suppliers that report payment history to commercial bureaus, helping build business credit. Vendor trade lines with net 30 suppliers report your payment behavior to commercial credit bureaus, creating a positive payment history that forms the backbone of your business credit profile. Okay, moving right along. That brings us to Module 2. Module 2: Stacking business credit products, from trade lines to 6-figure limits. Understand how to strategically layer business credit products to maximize available capital for real estate acquisitions.
In this part of the show, we'll talk through the credit stacking strategy, timing your applications for maximum approval, which business credit products actually fund real estate deals, managing utilization and credit cycling for ongoing deals.
Credit stacking sounds complicated, but the core idea is simple. You apply strategically, in the right order, at the right time, so you get the most money approved before lenders start seeing each other's inquiries on your file. Think of it like a chess game, not a sprint. Every move you make affects the next one. The investors I've seen do this successfully weren't necessarily the ones with the best credit scores. They were the ones with the best strategy. They knew which lenders to approach first, how long to wait between rounds, and exactly how to position their business to look fundable. Let me break that down a bit more. Credit stacking is the deliberate process of applying for multiple business credit products in a compressed time window to minimize the impact of hard inquiries and maximize total approved limits before lenders adjust their exposure to you. The strategy works because commercial credit bureaus do not update in real time, so applying to 5 to 8 lenders within a 30-day window allows each lender to evaluate your file before the other's inquiries appear. You should target no personal guarantee business credit cards first, then move to business lines of credit, and finally business installment loans as your profile strengthens. The ideal target is to accumulate $100,000 to $250,000 in available business credit before approaching your first real estate deal, getting you enough capital to cover down payments, renovations, or earnest money. Always pay balances down to below 10% utilization within 30 days of any large spend to preserve your credit score for the next round of applications.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: strategic timing in credit applications is as important as the quality of your credit profile. Sequence and speed both matter. Okay, quick pop quiz for everyone listening. Why is it beneficial to apply to multiple business credit lenders within a compressed 30-day window during the stacking strategy? Your options are: because lenders offer better rates during promotional periods in that time frame, because commercial bureaus do not update instantly, so each lender evaluates your file before others' inquiries appear, because your personal credit score is temporarily boosted during that period, because lenders share approval data with each other in real time. Take a second and lock in your answer.
Alright, the correct answer is because commercial bureaus do not update instantly, so each lender evaluates your file before others' inquiries appear. The delay in commercial bureau reporting means each lender in your stacking window sees a cleaner credit file, increasing the likelihood of approvals and higher limits. Let me walk you through what this actually looks like in practice. Say you find a property that needs $15,000 down and about $20,000 in light renovation. If you've done your credit building work, you might have a business line of credit at $50,000 and a couple of business cards with cash advance capability. You draw from the line for the down payment, put renovation materials on the cards during the 0% APR window, and when the property sells or refinances, you pay it all back. That's the machine. It takes setup time, but once it's built, it gives you real flexibility that most investors simply don't have. Let me break that down a bit more. Not all business credit products are created equal when it comes to funding real estate. You need products that provide liquid capital or can be used at closing and settlement. Business credit cards with high limits and cash advance features can cover earnest money deposits, inspection fees, and small renovation costs. Business lines of credit, particularly those above $50,000, offer revolving liquidity that can be drawn at will and replenished as properties are sold or rented. SBA microloans and community development financial institution loans, while slower to obtain, provide lower interest capital that can fund gap financing between a hard money loan and final settlement costs. Some investors also leverage 0% introductory APR business cards to fund short-term flips interest-free during the promotional period, then pay off the balance from sale proceeds before interest accrues.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: match the credit product to the deal type. Different stages of a real estate transaction call for different financing instruments. Okay, quick pop quiz for everyone listening. Which business credit product is most commonly used by investors to fund short-term renovation costs interest-free on fix and flip properties? Your options are: SBA 7 long-term loans, business credit cards with 0% introductory APR promotional periods, hard money loans from private lenders, home equity lines of credit tied to a primary residence. Take a second and lock in your answer.
All right, the correct answer is business credit cards with 0% introductory APR promotional periods. Business cards with 0% intro APR allow investors to fund renovation expenses interest-free during the promotional window, with repayment coming from sale or refinance proceeds before interest kicks in. Okay, so here's where most people start to lose the game after they've built it. They get the credit, they use it on a deal, and then they forget to manage it. Utilization is like the blood pressure of your credit profile. When it spikes and stays high, lenders get nervous and start pulling back. I've personally seen investors lose $40,000 in credit limits because they carried a high balance for 3 consecutive months without paying it down. The fix is simple. Pay down before your statement closes, not just before the due date. Those are two very different dates, and knowing the difference keeps your profile healthy for the next deal. Let me break that down a bit more. Once you have significant business credit available, your ability to keep using it depends entirely on how responsibly you manage utilization, the ratio of what you owe versus what is available. Lenders pull business credit profiles during annual reviews and can reduce your limits or close accounts if they see consistently high utilization or late payments. The ideal utilization for maintaining and growing business credit is below 30%, with below 10% being optimal before applying for new credit. Credit cycling is the practice of charging large amounts to a card, paying it down before the statement closes, then charging again, effectively using more credit than your limit suggests while keeping reported utilization low. During active real estate transactions, set calendar reminders to pay down business card balances before statement closing dates so your credit report reflects low utilization even during high spend periods.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: your statement closing date, not your due date, is what determines the utilization your lenders and bureaus see. Okay, quick pop quiz for everyone listening. What is credit cycling in the context of business credit management? Your options are closing old credit accounts and opening new ones to reset credit history, applying for new credit products every 6 months on a rotating schedule, charging large amounts, and paying them down before the statement closes to keep reported utilization low, using multiple business entities to cycle credit applications. Take a second and lock in your answer.
All right, the correct answer is charging large amounts and paying them down before the statement closes to keep reported utilization low. Credit cycling allows investors to use more of their available credit than the limit implies while keeping the reported utilization low, preserving credit scores and lender confidence. Okay, moving right along. That brings us to Module 3. Module 3. Deploying business credit in real estate deals. Deal structures that work. Identify and execute specific real estate deal structures that allow business credit to serve as a primary or supplemental funding source.
In this part of the show, we'll talk through using business credit for down payments, legal, ethical, and effective, the BRRR method supercharged with business credit, wholesaling and fix and flip deals funded by business credit.
I know what you might be thinking. Isn't it illegal to use credit for down payment? And my answer is it depends. For conventional mortgages on personal residences, yes, that gets complicated fast, but we're not talking about that. We're talking about investment properties purchased through your LLC, often financed by hard money or commercial lenders who evaluate deals very differently. In that world, where the money came from matters a lot less than whether the deal makes sense. That said, always, and I mean always, disclose everything to your lender in writing. Transparency is what keeps you on the right side of this. Let me break that down a bit more. One of the most common misconceptions is that using credit for a down payment is illegal or automatically disqualifies you from a mortgage. This is not universally true and depends heavily on how the transaction is structured. When purchasing an investment property through your LLC, you are not subject to the same owner-occupant lending restrictions that apply to personal mortgages, giving you more flexibility in how the down payment is sourced. Cash advances from business lines of credit deposited into your business checking account are generally acceptable for commercial real estate purchases, particularly when using private or hard money lenders who care more about the deal's profitability than the down payment source. Always disclose the source of funds to your lender in writing and get their written confirmation that it is acceptable before proceeding. This protects you legally and keeps the transaction clean. Working with a real estate attorney who understands creative financing will ensure each deal is structured compliantly without leaving you exposed.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: the lender type determines how your capital source is evaluated. Structure your deals with the right lender for your funding strategy. Okay, quick pop quiz for everyone listening. Why do hard money lenders typically have fewer restrictions on the source of a down payment compared to conventional mortgage lenders? Your options are: hard money lenders are not regulated by any government agency. Hard money lenders primarily evaluate deal profitability and collateral value rather than the borrower's personal financial history. Hard money lenders require no documentation of fund sources. Hard money lenders only fund deals under $50,000. Take a second and lock in your answer.
All right, the correct answer is hard money lenders primarily evaluate deal profitability and collateral value rather than the borrower's personal financial history. Hard money lenders are asset-based lenders who focus on the property's value and the deal's profit potential, making them more flexible about how the investor sources their down payment. BRRRR on its own is powerful. BRRRR with a funded business credit war chest behind it is a completely different animal. Here's why. The biggest failure point in BRRRR is running out of renovation money midway through a project. When you have a business line of credit at, say, $75,000 sitting there ready to draw from, that failure point disappears. You buy the property, you fund the rehab, the property gets rented, and then the refinance pays back everything you drew on business credit. And then you do it again. The same dollars doing the same work over and over. That's how portfolios get built without requiring constantly larger mountains of personal cash. Let me break that down a bit more. The BRRRR method, buy, renovate, rent, refinance, repeat, is one of the most powerful wealth-building strategies in real estate, and business credit amplifies it by solving the biggest barrier, the upfront renovation capital. Using business credit to fund acquisition and renovation costs allows you to buy distressed properties without tying up personal savings, complete the rehab, stabilize the property with a tenant, and then refinance with a conventional or portfolio lender to pull out capital and repay the business credit. The refinance triggers cash-out proceeds that replenish your business credit balances, resetting your capacity to fund the next deal. The key metric to track is the after-repair value, or ARV. Your renovation budget should leave at least 75% of ARV available for a cash-out refinance, ensuring you can fully repay business credit and retain equity. When executed properly, this cycle allows you to scale your portfolio using the same pool of business credit repeatedly.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Business credit used in BRRRR is not consumed, it is cycled, making it a reusable engine rather than a one-time resource. Okay, quick pop quiz for everyone listening. In a BRRRR deal funded with business credit, what event typically replenishes the business credit used for acquisition and renovation? Your options are monthly rental income from the property, the cash-out refinance proceeds after the property is stabilized and appraised, the sale of another property in the investor's portfolio, a subsequent business credit application for a new line. Take a second and lock in your answer.
All right, the correct answer is the cash-out refinance proceeds after the property is stabilized and appraised. After renovating and renting the property, a cash-out refinance at the higher ARV generates proceeds that can be used to repay the business credit drawn, resetting capacity for the next deal. For the investors who want faster deal cycles and faster money back in their pocket, wholesaling and flipping are where business credit really shines. Think about it. A wholesale deal might only need $2,000 in marketing spend and an earnest money deposit. If you collect a $15,000 assignment fee 2 weeks later, that business credit was just deployed and returned in half a month. That's an incredible return cycle. Even on flips, if you buy right and manage your renovation budget carefully, you are in and out in 6 months or less. The key is keeping a buffer, never deploy every dollar of available credit, because the unexpected will happen and you need to be ready. Let me break that down a bit more. For investors who do not yet want long-term holds, wholesaling and fix and flip transactions offer faster capital cycles that pair naturally with business credit products, especially those with short-term or 0% promotional windows. In wholesaling, business credit covers marketing costs, skip tracing services, direct mail campaigns, and earnest money deposits on contracts, expenses typically ranging from $500 to $5,000 per deal that return quickly once an assignment fee is collected. Fix and flip deals require more capital but also generate faster returns, making them ideal for business credit cards with 12 to 18-month 0% APR windows that cover renovation expenses repaid from sale proceeds. Track your cost per deal metric obsessively, knowing that every flip costs you $30,000 in credit and returns $50,000 in proceeds allows you to calculate exactly how many business credit rounds you can execute per year. Always leave 20% of your available business credit undeployed as a liquidity buffer for holding costs, carrying costs, or unexpected deal complications.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Always keep a credit reserve. The deal you think will go perfectly rarely does, and prepared investors survive while unprepared ones fail. Okay, quick pop quiz for everyone listening. Why is it important to keep at least 20% of available business credit undeployed during active real estate transactions? Your options are: because lenders will close accounts if all available credit is used at once, to maintain a liquidity buffer for unexpected costs such as holding expenses, delays, or deal complications, because the IRS requires businesses to maintain reserve credit, to qualify for higher limits during the next credit application round. Take a second and lock in your answer.
All right, the correct answer is to maintain a liquidity buffer for unexpected costs such as holding expenses, delays, or deal complications. Real estate deals frequently encounter unexpected costs, and keeping a reserve of undeployed credit ensures you can handle surprises without missing payments or stalling a deal. Okay, moving right along. That brings us to Module 4. Module 4, protecting your strategy, risk management, legal structure, and long-term scaling. Implement protective legal structures and risk management systems that allow you to scale your business credit real estate strategy sustainably without catastrophic exposure.
In this part of the show, we'll talk through separating personal and business risk, the corporate veil in practice, what happens when deals go wrong, credit repair and recovery, scaling to a portfolio, when and how to add entities, credit lines, and markets.
Here's what keeps sophisticated real estate investors sleeping at night. They know that if something goes wrong with one property, it stays contained. That's what the corporate veil does. It's not just legal jargon. It's a real wall between your personal life and your business risk. But that wall only holds if you maintain it. The moment you start mixing personal and business money, signing contracts personally instead of through the LLC, or failing to document your business decisions, that wall starts to crack. And once it cracks, a plaintiff's attorney will walk right through it and come after everything you own personally. Let me break that down a bit more. The corporate veil is the legal separation between you as an individual and your business entity, and maintaining it is the single most important protective action you can take when using business credit in real estate. To preserve the veil, you must hold annual meetings and document them, maintain separate bank accounts for every entity, never use business funds for personal expenses without a formal loan or distribution agreement, and ensure all contracts are signed in the entity's name rather than your personal name. Real estate investors who operate multiple properties should consider creating separate LLCs for each property or each market, with a parent holding company providing operational oversight and shared services. This structure ensures that a lawsuit against one property cannot reach the assets held in another. Personal guarantees on business credit products should be minimized and strategically avoided. As your business credit profile matures, seek products specifically underwritten without personal guarantees, which exist across credit cards, lines, and equipment financing in the business credit world.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. The corporate veil is only as strong as the discipline with which you maintain it. One act of commingling can cost you everything. Okay, quick pop quiz for everyone listening. What is the corporate veil and why is it critical for real estate investors using business credit? Your options are a type of insurance policy that protects business assets from lawsuits, the legal separation between an individual and their business entity that limits personal liability, a contractual clause in commercial leases that limits tenant liability, a federal regulation governing business credit reporting. Take a second and lock in your answer.
All right, the correct answer is the legal separation between an individual and their business entity that limits personal liability. The corporate veil is the legal barrier that separates you personally from your business, protecting your personal assets from business liabilities, but only if you maintain proper corporate formalities. I want to talk about the uncomfortable part that most courses skip. What happens when it doesn't work out? Because sometimes deals go sideways. Renovations cost double what you planned. A tenant trashes a property. A market shifts. And when that happens, business credit accounts can come under stress. The most important thing I can tell you is don't hide. Don't avoid the lender's calls. Reach out proactively, explain your situation, and ask about hardship options. Lenders would rather restructure a balance than write it off. Recovery is real and it's faster than you think, but only if you face it head-on and have a plan. Let me break that down a bit more. Even the best investors encounter deals that do not perform as expected, and understanding your recovery options before you need them is what separates resilient investors from those who never recover. If a business credit account goes delinquent, the impact on your business credit profile can be significant but is not necessarily permanent. Commercial bureaus weigh recent payment behavior heavily, so consistent on-time payments after a delinquency restore your profile faster than most people realize. Negotiate directly with business credit lenders before missing a payment. Most have hardship programs that pause minimums, reduce interest temporarily, or restructure balances without reporting a derogatory mark if contacted proactively. If a real estate deal forces losses that make certain credit balances unmanageable, prioritize accounts that report to personal bureaus for minimum payment compliance first to protect your personal FICO score, which anchors your ability to obtain personal mortgage financing. Rebuilding after a setback requires 12 to 24 months of consistent on-time payments, strategic new trade line additions, and utilization management, all entirely achievable with discipline.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: proactive communication with lenders before default is always more powerful than reactive damage control after it. Okay, quick pop quiz for everyone listening. What is the most effective first step when a business credit account is at risk of going delinquent due to a troubled real estate deal? Your options are: transfer the balance to a new business credit card immediately, contact the lender proactively to discuss hardship programs before missing a payment, file for business bankruptcy to protect personal assets, stop using the account and wait for the deal to resolve itself. Take a second and lock in your answer.
All right, the correct answer is contact the lender proactively to discuss hardship programs before missing a payment. Proactive communication with lenders before delinquency often unlocks hardship programs that can restructure payments or pause minimums without triggering negative credit reporting. So you've done the first deal. Maybe the second. Things are working. Now the question becomes, how do I grow this without it all coming apart? The answer is intentional scaling. One entity, one market, one deal type at a time until you've proven the system. Then you layer in the second entity, build its credit the same way, and now you have two pools of capital running in parallel. The investors who get to 10, 20 properties using this model aren't doing anything more complicated than what you've already learned in this course. They're just doing it repeatedly, systematically, and without letting the operational side of the business fall apart while they're chasing the next deal. Let me break that down a bit more. Scaling a business credit-funded real estate portfolio requires a deliberate approach to entity multiplication, credit line management, and market selection that grows your capacity without outrunning your operational ability to manage it. Once your first entity has a mature credit profile and an established rental or flip track record, you can form a second entity that benefits from the credibility of your first. Some investors use a parent holding company as a guarantor for subsidiary operating entities, which accelerates credit approvals for the new entity. Each new market you enter should be analyzed using the 1% rule as a baseline. Monthly rent should equal at least 1% of the purchase price, and then refined with actual cap rate data from local brokers and recent comparable sales. Hire or contract a property manager before you scale beyond 3 units, because the operational demands of self-managing will consume the time you need for deal sourcing and credit management. The most successful portfolio builders using this strategy target $1 million in available business credit across 2 to 3 mature entities, giving them the flexibility to move on multiple deals simultaneously without depleting any single entity's credit capacity.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: scale your entities and credit pools in parallel with your deal flow. Never let your credit capacity fall behind your investment ambition. Okay, quick pop quiz for everyone listening. What is the primary advantage of establishing a parent holding company when scaling a multi-entity real estate business? Your options are: it eliminates the need for property management across all entities. It allows the credibility and credit history of the parent entity to support credit approvals for subsidiary operating entities. It reduces property taxes across all properties held within the structure. It converts all real estate income to capital gains tax treatment automatically. Take a second and lock in your answer.
All right, the correct answer is: it allows the credibility and credit history of the parent entity to support credit approvals for subsidiary operating entities. A parent holding company with an established track record can act as a guarantor or reference entity for newer subsidiaries, accelerating credit approvals and higher limits for the newer entities in the structure. And that's a wrap on business credit to real estate, the insider blueprint for funding properties without personal liability. You now have everything you need to put this into practice.
Thanks for hanging out with us today. Take what you learned, start applying it right away, and keep going. We'll see you in the next episode. Good luck out there.